Welcome to The Explainer. Today we're diving into Owens Corning's latest earnings report. Now, the headlines pretty much all screamed miss, but as you'll see, the full story is a whole lot more interesting. So let's get into what's really going on behind the numbers. So this is the number that grabbed all the attention. A miss of 26 cents per share compared to what analysts were expecting. And yeah, on the surface, that looks pretty disappointing. But you know, a single number almost never tells the whole story. So what's the real context here?
All right, so to really understand that number, let's start with the top-line results for the fourth quarter. And there's no sugarcoating it. It was, without a doubt, a tough period for the company.
And wow, this chart really lays it all out, doesn't it? It wasn't just one thing. They missed on earnings per share, or EPS, coming in at $1.10 when the expectation was $1.36. And on top of that, they fell short on revenue too. That $2.14 billion they brought in, well, it was about 29 million shy of the forecast. So yeah, a clear miss on both key metrics. Okay, so you see the miss. The big question is why, right? Was this a problem with the company's performance, or was something bigger happening in the market? Well, it turns out it was a little of both, starting with some pretty significant external pressures.
Their CEO, Brian Chambers, put it pretty bluntly. He called it progressively more challenging market conditions. And you can see why. They were getting hit from all sides. The housing market was soft, their distributors were destocking, basically selling off what they already had instead of buying new stuff. And get this, it was a quiet storm season, which meant a lot less demand for roofing repairs.
But here's the kicker, the tough market, that wasn't even the biggest factor behind that headline earnings number. A huge part of the story was actually an internal accounting move, something called a goodwill impairment charge. It's basically an on-paper adjustment, it's non-cash, but boy does it have a massive impact on the official bottom line. And when I say massive, I mean it. We are not talking about a small adjustment here. We're talking about a $1.1 billion write-down related to their doors business. This single, non-cash accounting move is the main reason those official earnings looked so rough and why the quarter appeared so challenging on paper. Okay, so Q4 looks rough on paper, for sure. But, and this is a big but, if you zoom out and look at the entire year, a totally different and frankly much more positive picture starts to emerge. And you can bet the company wants investors to focus on that underlying strength, not just the quarterly noise. And you can really see that change in perspective in this quote from the CEO. The message is crystal clear. Don't get bogged down in one quarter's results. Look at the fundamental health and the strategic progress of the business over the long haul. And look, talk is cheap, right? But putting your money where your mouth is, that says something. And in 2025, Owens Corning put $1 billion back into the hands of its shareholders. That's a huge amount of cash delivered through dividends and by buying back their own stock. And these numbers for the full year, they really tell that stronger story. I mean, they pulled in over $10 billion in revenue, kept a really healthy 22% adjusted profit margin, and generated $1.8 billion in cash from their operations. This is actually their fifth year in a row with these kinds of profit margins, which shows just how consistent they are, even in a weaker market. So, you're in this tough market. What's the game plan? How do you not just survive, but actually come out on top and grow? Well, they've laid out a really clear strategy for this, and they're calling it the OC Advantage. At its heart, it's actually pretty simple. It's about doubling down on what already makes Owens Corning, well, Owens Corning. It's not about some crazy new invention. It's about using their existing strengths in a smarter, more powerful way. And it's all built on 4 key pillars. So here they are, the 4 things they believe give them an edge. First, that iconic brand. I mean, who doesn't know the Pink Panther, right? Second, their commercial strength. They have these deep, long-standing relationships with dealers and contractors. Third is technology. They launched over 30 new products just last year. And fourth, their cost position. They are laser-focused on being a super efficient manufacturer, even using AI to make their supply chain smarter. That's the playbook. All right, so that's the strategy. Now, how does that translate into what they expect for the year ahead? Well, they're basically telling a story of 2 halves, a slow start, followed by, hopefully, a strong finish. And you got to give them credit, they're being super upfront about this. They're signaling that the first quarter of 2026 is still going to feel the pain of that weak market, with profit margins in the mid-teens, but they expect things to get better and better as the year goes on. They see the markets improving, roofing demand getting back to normal, and their full-year results landing pretty much where Wall Street expects them to be. And here's a look at the hard numbers for their 2026 outlook.
The one that really jumps out to me is that capital additions line, around $800 million. That means they are planning to spend a ton of money on strategic projects, modernizing their facilities, and building out more capacity to fuel future growth. They're investing right through this current soft patch. Which brings us to the big, lingering question, doesn't it? Owens Corning has laid out a really clear strategy with the OC advantage. They're investing heavily for the future, and they're betting that the market is going to turn back in their favor. The plan is there, the money is being spent, but will it be enough to turn these market headwinds into powerful tailwinds? Their success really hinges on executing that plan in what is still a recovering, and let's be honest, a very uncertain market.